How's it going, subscribers? Today we're going to be talking about the company and the stock NIO, NIO. So I've already made 6 NIO videos and this is my 7th one. So make sure you guys check out all my first 6 NIO videos. And I go over NIO in a little different ways. And I analyze different fundamentals and technical aspects of NIO. So check those other videos out, and let's get started with this video, which will also be somewhat different. So in the last video, we went over the value of NIO, and in this video, we're going to be talking about the future growth of NIO. So when it comes to the future growth of NIO, we're going to give NIO 5 stars out of 6. 5 stars out of 6. How is NIO expected to perform in the next 1 to 3 years based on estimates from 9 analysts? We're going to give it a 5 out of 6 when it comes to that. That's good. Now, the expected annual growth rate, what are we looking at? We're looking actually at a 40.1% annual growth in earnings. So we're looking at a huge increase in earnings. Now, when we compare the estimated growth in earnings of NIO to the auto and the market and low risk savings, we're actually expecting a higher return on NIO over automotive companies, the market, and also low risk companies. So NIO is definitely has more potential than just investing in some random automaker company and some random stock market company. And it's also has way higher growth potential than low risk savings. So let's look at the annual growth rates comparison over here. When we look at the revenue, we can see that the revenues we're expecting the revenue to increase over the years from 2019 all the way to 2024. We're expecting it to increase. We're expecting the earnings to increase. We're expecting we're expecting the revenue and the earnings essentially to increase. In the cash flow and the growth rate, we're hoping that it will do well as well. Now, when we look at the past and future earnings per share, we can see that historically, we're expecting it to increase, and then we're expecting the growth to slow down after 2020. So after 2020, we're expecting the growth to slow down, the earnings essentially to slow down for NIO. And when we look at the performance in 3 years, we can see that NIO has actually got a minus 184% return on equity. This means that NIO has lost a lot of equity. It did very poorly when it comes to the return on equity in the past 3 years when we compare NIO to the automotive industry. So when we look at NIO, it is unable to establish if NIO will efficiently use shareholders' funds in the future, return on equity greater than 20%, as it is not expected to be profitable. And that makes sense because NIO's still starting out. NIO's still working on its electric cars. It's even behind Tesla. So we're going to expect it to lose money for a while, just like Lyft and also like Uber. These 3 companies are essentially expected to lose money. So if you guys want me to go over the past, subscribe, like, and